This is a Momentum Media production.
Welcome to Property Showcase, the podcast that brings you closer to the service providers that can inform your decisions about how you buy, manage and research top investment opportunities. Be informed and become a better investor with Property Showcase.
Hello everyone. Being better informed is the name of the game when it does come to property investing. Welcome back to a brand new episode of Property Showcase. I'm Grace Ormsby. It is a pleasure to be chatting around a pretty important topic at this time of year. It is tax time. If you don't already know, you should be quite aware, but we'll put it on your radar if you're not. Brad Beer, welcome to the show.
Grace, lovely to be here. Tax time's always exciting. We get excited around these times of year.
You are the CEO of BMT. You are dealing with tax all the time, but this time of year is pretty critical. Yeah,
look, critical because it's the time that we go to do tax returns. What we do in depreciation saves people a lot of money. So now's the time you should be thinking about it and, don't miss out.
So what then, for those that don't know, because this is all about giving people the information, arming them with the things that they need to really, fast track's probably not the right word, but to really ensure that they are taking the right track when it comes to building out a portfolio, and tax time is obviously part of that. But property depreciation in itself is a huge part of this and making sure you get that right. What then is property depreciation for those that aren't aware? Yeah,
I think the easy way to have people understand depreciation is probably use an example I've done once or twice before in a car. We understand we buy a car, we drive it out of the shop, it's worth heaps less money. It's depreciating in value. Now, for property as an investment, we want it to appreciate in value, but the actual bricks and mortar and the building itself and the things in there are actually wearing out like your car does. And the tax office allows us to claim a tax deduction for that wear and tear on the carpet and the stove and the bricks and mortar effectively as a tax deduction each year. And what it means for a property investor, I'm a property investor, I'm investing in property to make some money. The depreciation is a non-cash tax deduction. It's probably the second biggest deduction anyone makes. First year average out of what we did last year is nearly about $9,000. So it's a pretty big amount of money and we're there trying to make money. It makes a big difference. And so that's, what it is and why it's important is it's about money. It's really simple.
I feel like that is really what we need to get through people's heads as well. Like, it is important. It can save you money. It can make you money on something that you want to be making money off. Why else do people go into property investment?
Exactly. And given that the average first year of claim is, as I said, nearly $9,000 and you don't pay for it, it's a non-cash deduction. We're all looking around for our receipts to claim our lawn mowing or whatever it is. And there's a $9,000 one on average that people are going, what's that, Brad? You do what?
Yeah,
and they're property investors.
Yeah, they need to know about these things. And BMT is obviously a massive player in the space. You guys are doing some amazing work, but the education piece is so important.
Yeah, there's a couple of hundred staff in my organisation and I've been doing it for 26 years. We've done 900 and something thousand depreciation schedules for investors and got them lots of money.
Well, there you go. And quantity surveyors are massive. They're the bread and butter of what depreciation can be.
They are, due to some rules the tax office have. The claims we make relate to the construction cost of the building and the value of some items in the building. So we, as a quantity surveyor, our normal job, if you want to call it that, is estimating the cost of buildings. So we can get a set of plans and we can count the number of bricks for you and everything in the building and come up with a construction cost that it should cost to build it. So the reason that we get involved is that the tax office says we want all the actual real costs, which are often hard to get, or we want an estimate done by a relevant professional such as a quantity surveyor, is their words, being these guys know about construction costs. They normally count bricks. So the cost they come up with will be accepted by the tax office for the purpose of these depreciation claims.
Most people already use an accountant. What makes a quantity surveyor different or still needed in this when, there's probably a few people at home and they're probably not quite as informed as you or I, but the accountant isn't necessarily equipped to be able to do all of these things.
And the big difference is that we're a piece of your tax return. The accountant sort of drags all the pieces together, I suppose, and has the advice on what to do. One of those things is claim your depreciation. The tax office recognises us as the cost guys to come up with those numbers, and we pull together a depreciation schedule which the accountant pulls together as part of the tax return. The accountant doesn't count bricks, isn't a quantity surveyor, so they won't be accepted to come up with those construction costs. Hence, we work alongside them. Most of the work we do is referred by an accountant who says, you need one of these, go off, get one. And they go,
we can't do that for you. Yeah.
Yeah. And so that our relationship with the accountant is we're their friends, we work with them, we're not trying to compete with them in any way.
I guess for an analogy, it's probably like an employer is the one that is responsible for taking out the tax and passing over that thing to say, we've paid this already, this has all been done, and then the accountant can use that.
It's like that, or I kind of always think it's like your doctor and your ear specialist, where the ear specialist, the doctor's a generalist of knowing about ears, but not everything about your ear, I suppose. I don't know why the ear specialist
That
came
is
there.
a really good analogy. I love that one. I mean, it comes in, I guess, doctors, you're probably more likely to see them when you're older. Not always the case, but probably a few more issues there. But a lot of people probably think it's not worth getting an older property looked at and considered for tax depreciation because it's already too old.
Yeah, and age doesn't matter. That's what we're going to say. An older property doesn't get as much depreciation as a new property. New property gets the most, and it's like your car. When it's new, it depreciates the most, doesn't it? That's when you do the big depreciation. But if you buy a second-hand property, things are older, so they cost less, so they're not worth as much, so the depreciation you claim is less. And there's a few rules around older properties. Some need, but I almost say, like, don't worry about the age of the property. Ask the quantity surveyor whether we can get any money, because old property still gets it, just doesn't get as much. Now, there's some age importance and things as to how much you'll get, but we can easily have a look at, the photos we can see and have a few questions about your property, which we'll do at no cost, and go, yes, we think it's worth it. We think we should get roughly this much in deductions, and we can decide whether the exercise is worth going through before you actually spend any money.
That's really good to know.
And look, even on top of that, we still do a double the fee or no charge guarantee. So if we look at it and we, based on the questions, think there's enough there and we're wrong, we'll still cancel it and give you the money back and we move on with our lives. Because if you don't get deductions, and we've done so many of them, if we can't get a pretty good idea of what we're going to get before we actually get there, at least within range, then I'm a bit concerned. So we'll back that and go, if we are wrong and we thought we could find something we didn't, but we can work it out pretty easily as to whether there's enough money being spent, work being done, whatever it is, the age of the property, a few factors that come in there that we go, yes, worth it, no, not worth it, let's go and do it, or let's not go and do it.
There you go. One of those things then too that people probably aren't sure about is they've got an old property. They've probably written off any idea of depreciation, but then they go and do, as you said, some work on the property. They do spend some money. Renovations is probably when it gets a little bit complicated.
Yeah, look, little, but not too bad. A renovation just means that there's actually money being spent on the property. So there's more things to claim. It's like a new piece on your car. You've put a new part on your car. There's another thing there that we can claim some deductions for. But there's two parts. One is that, obviously, more money, more spent, more depreciation, so we get excited. But before you rip it apart is an important part of renovation as well. Make sure you've got a depreciation schedule. Make sure you call a quantity surveyor before you rip it apart, because there may be things in there that still had some value that you thought were old and maybe there was no claims, but that doesn't mean there's none. If we tell you there's none. But if the things you throw out still have some value left from a depreciation point of view, then you do what we call scrapping. Well, It's not the tax office term, but people understand it. You scrap it, you throw it away. Whatever residual value was left on some of those things can be an instant deduction that year. So scrapping, if you're renovating, call a quantity surveyor first in case there's some value before you throw it away. And we kind of want to see it there before you throw it away. So if the tax office asks questions, in 3 years' time about this big tax deduction for this stuff you've thrown away, we can go, yeah, we've seen it. It was there. Here's a photo.
Yeah. I mean, fair enough. These are all great tips. I think people should be writing notes if they haven't already started that with this podcast, because Brad, you're providing so much insight. This time of year especially, people are thinking about tax, but something tells me that this is not the only time that people should be going, okay, I've got a property depreciation schedule. Like, how do I keep that up to date?
Yeah, so keeping it, once we do it, it should be done unless you've made changes. There's no Like if you buy a new property now, we do it today, you've got 40 years of claims and we tell you how much they are for 40 years. But as you do changes, renovations and things, yes, it does get updated over time, and you can even just, when we've done it, you can log into the portal and add your new stove yourself, and it's free. You just update it and your accountant gets the new numbers basically. But tax time at the moment, I think one of the most important things to think about is if you haven't been claiming it as much as you can, if you haven't been maximising it, or you've thought it was old and you're claiming nothing, or you just didn't know and claiming nothing, you can actually go back and amend up to 2 years of tax returns. Very easy to go, well, last year I should have claimed $5,000 and I didn't know because it was an old property, and then I listened to this today and found out that there should be some deductions there. You can go back and fix 2 tax returns. So that does mean some good cash sometimes. Go back and make another $5,000 tax deduction last year that you didn't make. Then at your tax rate, you're going to get some cash back probably.
Yeah.
Even if you've owned it for like 5 years or whatever, you can't go back 5 years, but you can go back and amend the last 2. Now, the important thing to think about at tax time here where we are now is you're about to do another tax return. So don't take another year off your back claims.
Yeah.
Because you'll have depreciation in that year if there is any. Don't miss out another year if you've been missing out, I suppose. And that, as I say, is both if you've been claiming nothing or even if you've been claiming not as much as you could. My job is to come in and, estimate the cost of construction for the purpose of this depreciation, and also what we do is maximise that deduction. So we try to make it as high as we legally, of course, can by knowing the rules, getting out, visiting the property, finding everything and getting all these deductions set up so that you can go back and get as much as you can out of it, basically. So we can help facilitate to look at what the previous years could have been. And if you're claiming $3,000, it can be $5,000, you claim the extra 2. Really simple.
And for 2 years back, and I think it probably goes without saying, but I'm going to say it anyway, that if you have multiple properties that you don't have depreciation schedules for, if you go and get these, you're kind of compounding your returns.
Someone who became a good friend of mine after this, when I say good friend, a client, I think the best I've heard was nearly $90,000 in cash back from the tax office. In the past, you used to be able to go back 4 years. Now you can only go back 2. And this guy got nearly $90,000 in cash back. And another guy I did a lot of work for, I remember ringing me up saying, thanks, I got $50,000 back from the tax office by amending my previous returns. Now, they're obviously bigger property holders than someone with a simple residential investment property, but if you go and find a deduction that's $5,000 to $10,000 that you didn't know about for a couple of years, it's still a bit of cash. And, cost of living's tough at the moment, a little. Anything you can get, you might as well go and get it. I don't know that they that they spend it as well as we do, the tax office do.
I mean, as an aside, Brad, there's obviously some pretty obvious things that people can be claiming for, but for those people that think they've got it all under control, are there any sort of left of field things that they really should be making sure are being accounted for with this? Because there might be some red flags that people have going, oh, I've never actually thought about that. I probably should make sure I've got my tax depreciation in order.
I think if we set it right, if it's set right from the start, the only things that changes is your renovations and things that you do to the property. So set it right from the start is the important thing. And that includes not doing an online do-it-yourself depreciation schedule.
Probably see that a lot.
See that a lot. You know what? Cost less than half as much as mine does. Look, it's $700 we charge to do them. So, which includes what we think is a very important process, which is going to the house, taking some photos and making some measurements to make sure we find everything. Doing it without an inspection to me is cutting corners. Unless you've got absolutely every bit of information, and I'm sorry, but the photos online they don't have everything all the time. So you will miss things. You'll miss potentially renovation works, because renovations that have been done by a previous owner, there's still potentially some claims related to you as an owner now. So when you acquire the property at the time, or now when you've had it for 3 years and you realise you want a back claim, setting that depreciation schedule right from the start, getting it done properly with someone who will visit it, find everything and maximise that deduction is the important thing. You should be set and forget after that, unless you make changes, because the bricks stay the same other than changes that you make to them. So the really important thing is really setting it up properly at the start and making sure and that's what we've done 900 and something thousand times, is make sure you set a depreciation schedule properly at the start so you get all of your deductions out of that each year.
So how does that process work? How do people go? They probably listen to this and gone, okay, I probably should look into a depreciation schedule. What does the process look like if they've contacted you or the team?
Yeah, so at first we want to talk to them about their property. How old is it? Have you done works to it? Congratulations on buying it and making this call to get money out of it. And we'll just talk through the property. We'll identify to make sure that there's enough value in doing a depreciation schedule. And then we say, let's go ahead. From there, we'll collect. And we've got, hooks up to the data about when they bought it and what they paid for it usually. So we need to identify who the real estate agent is. We then go out. My team will go and visit the house. We go through with our little digital measuring tools and app and that we've built that they take some information, they take a bunch of photos. We organise that through the real estate agent and a convenient time with the tenant. Or if it's vacant, which is much nicer, go through without
easier.
them. It is easier. It's not the easiest part of the job, actually getting into people's houses all the time because they don't really want you coming through their house, taking photos of everything and in every room and measuring things up. But that's life. It's part of the job. And from there, we will, collect whatever information we need, come back, do the estimate of the cost of the property, put the depreciation schedule together, send it to you, send it to the accountant at the same time, and go make your deductions. Really simple. And the fee's deductible as well. So, process, that sounded very simple, but there's actually some work into doing that depreciation schedule. Like it doesn't pop out by itself. But, just go get everything we can out of it, prepare that report that tells you how much to claim each year. Just keep claiming.
And you mentioned it being a cost, but really, from what you've been talking about today, it's more an investment than a cost base, really.
Given the first year average is about $9,000, depending on your
Pays
tax
for
rate,
itself.
it's paid, over
18 times
$3,000.
over.
Well, yeah, basically. And then if it's new, you've got it for 40 years. And it's not $9,000 in year 40, but it still might be 5. So there's thousands of dollars each year in deductions for a whole lot of time, and you only have to buy it once. And it's the gift that keeps giving.
I love that, the gift that keeps on giving. And this time of year, tax time, is when people are thinking about it. But because really, if you're doing it yourself, the tax deadline is October. So you've only got sort of a short window. You've got a little bit longer if you are working with an accountant on that. But this time of year is when people really should be on the ball with this stuff if they want to make the most of getting that depreciation schedule.
Look, absolutely. The biggest thing I'd say is just don't do another tax return before you can back claim if you've been missing out. And just don't do this tax return without getting the money back. The other thing you can have done is the adjustment to your tax throughout the year. So rather than just getting a big lump of money back at the end of the year, your accountant will fill in a PAYE, whichever one of those it is, certificate that allows your employer to actually take less tax out of your income each fortnight based on what your tax return is going to look like at the end. And a depreciation schedule is a deduction that's a non-cash deduction. So it's the ones that make a big difference. Like interest you pay, you make a tax deduction. Tax depreciation, your building's wearing out, you make a tax deduction.
Yeah.
You don't pay that money out each year. So it makes a big difference. And you can look at having it reduced so you've got the money in your pocket to put in your offset account and reduce your interest payments or spend, which is probably not the best idea.
But one of those things to be thinking about as cost of living is rising and people are more worried, especially if they know what that income is going to look like. It is an easy way to just reduce some of those outgoings.
Absolutely, and reduce them on the way through. So when times are harder like this, sometimes it changes when people order from us. We keep good eyes on that through the year and the numbers change, and sometimes we try to, and then things like COVID mess up the way people order everything in life. So you just want to delete those 2 years out of all your metrics that you're trying to look at your business.
Of all outliers.
Yes, and GFCs and. For us, legislation changes sometimes make some change as well. But we work with all those and keep pushing along.
You guys would have a pretty good, I think, database or data set showing some of those environmental, economical things that have happened over the years.
Elections, they actually affect our order numbers. And, whether the Easter school holidays affect our numbers. So when we put together budgets and things, we've got to consider whether the holidays are going to fall out Easter or not Easter, because it actually affects the numbers and messes them up, because people are just doing different things in their lives, I suppose, and not just thinking about tax depreciation all day, which they should be, of course.
Which they should be all day, every day, because of the real savings that they can do. And BMT is obviously the best when it comes to this, Brad. It's been so wonderful to chat with you about all of this. And anyone who has been listening that does not have their tax affairs in order, they don't have a depreciation schedule, how can they reach out to you to get someone from the team to be looking into their particular property portfolio?
Very easy to find us. bmtqs.com.au is the website. Any Googling will find BMT pretty easy.
And as you said, the conversation itself is going to be an investigative exercise. There's no pressure if it doesn't actually work out that you are going to make money back from this.
If you're not going to make any money out of it, there's no use me selling it to you. The accountant is unhappy, you're unhappy, but we worked that out at the start and it doesn't cost anything to do that. So always worth, and we'd say regardless of age, that doesn't matter, always worth making the phone call and asking the question, see if you can get any money out of it.
There you go. The CEO of BMT, Brad Beer, thanks once again for joining us.
Thanks, Grace. Lovely.
To everyone who is listening along, if you have any questions, reach out to Brad himself or the team, or you can send us an email at editor@smartpropertyinvestment.com.au. That is all for today. Until next time, stay safe and well wherever you're listening from. Bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.